How to write covered calls on TD Ameritrade. In this video, we're first going to talk about what is a covered call. Second, we're going to talk about the benefits of writing covered calls. Third, we're going to talk about some of the risks of writing covered calls. Fourth, we're going to go over an example of how to sell a covered call and how to close out a covered call position before expiration. And finally, I'm going to show you the results from my covered call trades on one of my stocks over the past few months. All this right after. I am not a financial advisor. This video is for entertainment purposes only. Learn to invest like a wolf at your own risk. What's up, everyone? Welcome back to my channel, Wolves of Investing. My name is Donnie Nguyen and I'm the founder of Wolves of Investing. If you're new, my channel is primarily about investing in the stock market. If you want to learn how to achieve financial freedom through investing, be sure to click on that subscribe button and notification bell if you haven't yet. And please remember to drop a like on this video if you enjoy it, as it truly helps out the channel. So without further ado, let's get right into it. What is a covered call? A covered call is one of the most basic options plays you can do, and I think that the best way to explain what a covered call is through an example. Let's say that you own 100 shares of stock that you bought for $25 per share. For those of you who are brand new to options, one options contract represents 100 shares of stock. So in this example, you paid a total of 100 times $25 equals $2,500 for those shares. Let's say that you sell one covered call options contract on those shares with a strike price of $26 that expires next week. And let's say that you were able to sell that options contract for 40 cents. Because one contract represents 100 shares, you collect 100 times 40 cents, which equals $40 by selling that covered call. That $40 is called the options premium, and it's yours to keep. You can use that $40 to pay down your mortgage, pay down your student loan, or buy yourself a fancy dinner. Whatever you want to use it for, it's your cash to keep. When that option expires, two things can happen. If your option closes out of the money, meaning the stock is at or below $26 per share, then you'll keep your shares. If your option closes in the money, meaning the stock is $26.01 or higher, then your shares will get sold at the strike price of $26 per share. Either way, you get to keep that premium of $40. What are some of the benefits of writing covered calls? The main benefit is that you're able to lower the cost basis of your stock. For example, with our $25 stock, we paid $2,500 for 100 shares. But because we wrote a covered call, our total cost of ownership is $2,500 minus the $40 premium, so $2,460. It's as if we only paid $24.60 per share instead of $25 per share. This may not seem like a lot, but imagine if you can repeat this trade over and over again. Pretty soon, you will have significantly lowered your cost basis. The second reason, of course, is to just collect regular income on your stock. Many stock options have weekly expirations, so you can potentially collect premium on your stocks every week. So what are the risks of writing a covered call? The first risk is that the stock closes well above your strike price, where you'll still be forced to sell your 100 shares at the strike price. So in our $26 strike price example, if the stock closed at $30 per share at expiration, you'd still have to sell the stock at $26 and lose out on that extra $4 per share, or $400. So it's very important that you pick a strike price that you're comfortable selling the stock at in case it gets called away. Now, we don't have to wait for the option to expire. What we can do in this case is to buy back the option to close the contract. I try not to do this if possible because I will be paying a much higher price to buy back the option and thus negate all of my gains. So the only reason I would buy back my contract in this situation is if something fundamentally changed that makes me think the stock can sustain its new higher price. The second risk is that the stock tanks. But that risk is not that big of a deal if you pick the stock that you plan to hold long term. In fact, if you've been selling covered calls on that stock, you've been lowering your cost basis, so a decrease in the price of the stock should hurt much less than had you not been selling covered calls. All right, so let's walk through an example on TD Ameritrade's desktop app. You can also use the mobile app, or you can use Thinkorswim, which is a free platform provided by TD Ameritrade for its customers. As you can see, I have 100 shares of PSTH in my account. If I go to PSTH's stock profile page, I click on Options Chain. The default view just shows options that are near the money. I like to see all of the available options, so I click the range drop-down and change it from near the money to all, and then click the View Chain button to refresh the page. This view shows calls and puts. The calls are on the left-hand side, so that's what we're interested in. When I sell covered call options, I normally like to stick to expiration dates that are less than 30 days. So here we can see that it displays the number of days until expiration, and we can see that PSTH does have weekly options available. So first, I'm going to look at these options that have 6 days until expiration. Then I look for a strike price that I'm willing to sell the stock for at the expiration. And I look for the premium that I can expect to make from selling the covered call. Let's say that I chose the strike price of $24. The bid is 10 cents and the ask is 15 cents. This means that the current market value is somewhere between 10 and 15 cents. Then I'll go to the next expiration, which is 13 days, just to compare the premium at the same strike price. And we can see that the premium for the same strike price is between 30 and 40 cents. So let's say that I'd rather collect the higher premium and I feel comfortable with the 13-day expiration. So I'll select that option by clicking on the bid price of 30 cents to start my trade. To sell a covered call, we need to make sure that the action is set to sell to open, which means that we're selling a call to open our trade. Then we select the number of contracts we want to sell. In this example, I'm only selling one covered call. I always use a limit order on options to make sure that I get the best price possible. I usually place a limit order at the ask price, then I keep lowering it by a penny until it gets filled. So here I enter the limit price of 40 cents, and then I click Review Order. And before I place my order, I can review it to make sure everything looks correct. So we can see that I'm selling to open one contract of PSTH call option that expires on June 25th, 2021, with the strike price of $24. And we can see that if my order gets executed, I'll collect $39.35, which is just the 40-cent premium times 100 minus the 65-cent commission. And then I just click Place Order to place my trade. How do you close out your trade before expiration? So as you can see, I already have an open covered call on PSTH. To close it out, I would place a buy order on that options contract. And the action this time is buy to close, meaning that I'll buy back the option to close out the trade. In this case, I try to buy it back as cheap as possible. So I'll place a limit order at the bid price, and I'll keep on adjusting my order up by 1 penny until it gets filled. The bid is 5 cents and the ask is 15 cents. So I'm expecting it to get filled for 15 cents or less. I usually try to close out my covered call early as long as I'm comfortable with my profit, so that I can turn around and sell another covered call at a later expiration. My goal is to collect as much premium as possible before the stock tanks or gets called away. So finally, I wanted to show how I was able to collect premium on my shares of PSTH over the past few months. Here you can see that I bought 100 shares of PSTH at $24.50. I then sold several covered calls on it. Almost every time I closed out the covered call early. My total profits on these covered calls was $343.74. So my cost basis was $2,106.26. So it's as if I only paid $21.06 per share. It's actually less because I started out by selling a cash secured put option, which is another awesome strategy. But I'll save that video for another time. PSTH closed at $22.86 on Friday, but instead of being at a loss, I'm still at a profit because of my covered calls. All right, so before you leave, if you want to join the most awesome Discord community where we talk about SPACs and other stocks, check out my Discord link in the video description. We're over 500 members strong and it's absolutely free. And if you want more insights into my portfolios, or if you just want to support the channel, check out my Patreon. A link is also in the video description. And as always, a huge thank you to the awesome patrons that have already joined. All right, so let me know what you think about covered calls. Are you gonna start trading them? Drop me a line in the comments. Be sure to leave a like on this video before leaving. Thanks for watching, and I will see you next time.